let's move on and let's kickstart our coverage this morning with the macro data point that the market will be eyeing, the U.S. GDP print. Growth in the United States has come in at much weaker than what was expected. Meanwhile, prices continue to soar at a faster pace. The Q1 GDP for the January to March period increased 1.6% on an annualized basis versus the economic forecast that pegged growth at 2.4%. Following the 3.4% gain in the fourth quarter of 2023. While that was for growth, personal consumption expenditures, or the PCE index, rose 3.4% on a year-on-year basis. That, remember, is the biggest gain in the year and is up from that 1.8% print we did see coming in Q4. Important to note that growth has declined below the Federal Reserve's estimate for the first time in nearly 2 years. What's going to be bothersome for the central bank is to take a call that the slowing was coupled with faster inflation growth, which, if sustains, could be a dilemma for Jerome Powell and the FOMC going ahead as well.
All right, then let's also listen into what Jof Dennis had to say about that as well.
To the release of the GDP report because of the poor earnings released by Meta, which had pulled down the Nasdaq futures prior to the GDP report. I think the earnings story generally across the U.S. market will remain reasonably robust. Of course, the market is definitely richly priced. I don't deny that at all. I think the point I'm trying to make is that we have got 3 CPI releases before the July FOMC meeting, and while I don't think the March PCE logically will give us a positive surprise, a lower than expected number, because you've got all this sort of, it's all baked in the cake to a certain extent, and Q1 was strong.
All right, then staying with US, Treasury Secretary Janet Yellen highlights that US growth is firing on all cylinders despite the miss. She still sees strength in the underlying drivers of growth and believes in the potential of the US economy, while of course noting that while the headline growth rate came in below expectations, it was for reasons that are peculiar and not really indicative of underlying strength, and that's the word coming in from her.
Alright, let's shift focus from the US to Japan now, and consumer price index in Tokyo grew substantially lesser than expected in April, sinking below that Bank of Japan target and therefore complicating expectations for a more hawkish stance from the central bank. Headline Tokyo CPI is up 1.8% on a year-on-year basis. The reading comes hours before that key Bank of Japan outcome where the central bank is widely expected to keep interest rates steady after raising them for the first time in 17 years in March. And on the back of this, as of now, Nikkei is not doing much. Nikkei is rather flat, just up 0.1%, a 48-point uptick coming in, but nonetheless in the green.
Let's also take a look at center our focus on some key earnings then that we touched upon a little bit earlier as well. Microsoft delivered better than expected Q3 results with a 17% revenue growth. However, revenue guidance came in weaker than expected as the management highlighted AI demand coming in higher than their available capacity. Meanwhile, Alphabet shares rallied on that revenue beat in their Q1 results. Company also announced their first ever dividend coupled with a $70 billion buyback.
Well, lots happening, so let's keep it going with tech. Intel also delivered better than expected Q1 results on top and bottom lines. Shares took a beating on that weak guidance, and Intel expects earnings of 10 cents per share on revenue of $13 billion at the midpoint. On the flip side, Snap shares rose on an earnings beat. Revenue surged 21% on a year-on-year basis. However, net loss deepened to $305 million.
If you like this video, then like, share and subscribe to ET Now.